Yo, Z community cuties, what is poppin'? Now, as you guys have probably seen from the headlines right now, inflation sucks. I think we just hit what, like 4.4% in Canada at least. And in today's video, we're actually gonna talk about ways that you could protect yourself from inflation. So without further ado, let's get this party started. Alright, so a couple of points of what we're going to be talking about today. Number one, what is inflation and, everything around that? Inflation and its relationship when it comes down to the stocks and the stock market. And last but not least, things that you can do to protect yourself from inflation. Alright, so when it comes down to inflation, this is basically just a term that is used to describe money's value decreasing. Now, it's kind of similar to what we were talking about in our past video about cars and how they depreciate over time. The exact same thing applies to your actual cash. And if you haven't watched that video about the cars and stuff, check out one of the corners and be sure that you actually watch the video. Now, I think the easiest way to actually describe what this inflation does to you is, let's just throw it back, 7 years ago. When you'd go to McDonald's, you'd get yourself a junior chicken. Back in the day, it was $1.50. But if you ask the drive-through lady, hey, can I get a junior chicken? Guess what? It's $2.50 now. It doesn't really seem like much, but that's a 66% decrease in your money's worth from 7 years ago. Now, inflation is caused by three main things. Obviously, there's a couple of other things that do affect it, but it is more on the micro scale than it is on the larger scale of things. What are these three things? Number one, increased demand in certain products or services, increased production costs or increased wages, and last but not least, we probably would have guessed this, increased government spending. Now let's talk about increased production costs first, right? This is pretty self-explanatory. It's just, if somebody ends up raising your prices, you're gonna have to end up raising yours in order to sustain a good profit margin. So taking our junior chicken example, let's just say that it cost you, 50 cents for the entire junior chicken thing. The buns, the freaking burger itself, like you name it. But let's just say the guys that I get lettuce from and the buns from end up coming back to me and they're like, yo, Tamara from McDonald's, we're gonna increase the prices by 10%. What am I going to do in that type of situation? Well, obviously, I don't want to take a hit because I want to make sure that my business is profitable. So what I'm going to do is actually increase the cost of the junior chicken by 10% in order to make up for this loss. Obviously, it's not exactly 10%. There's a lot of different pieces of the puzzle that you have to make before making these increased costs. But the bottom line is companies need to make up for this. And I don't want to go on a tangent over here, but then you might be thinking, well, that's not fair. How come companies can't take the loss? It's simple. It's better for us to just spend an extra 10 cents, 20 cents, 25 cents, rather than the company taking the hit. Because think about it, if you're invested in McDonald's or any other company, just as simple as 4% of a difference makes a huge difference in terms of profitability and how the business runs overall. And I want to make a quick, simple little calculation over here. Let's just say it's a company that racks in $2 billion a year, right? Now, if there's a 2% production cost increase, that would actually equate to $40 million. Pretty big hit. But to you, at the end of the day, it's only 10 cents, 20 cents. All right, so back to our main point. The second thing that affects inflation is actually increased production costs or increased wages. So both of these things can actually be used interchangeably when talking about a business, but usually in times of high unemployment, such as what we've seen in COVID, businesses usually like to incentivize new people to come on board so that they can hire them. How do you incentivize somebody to come join your company? You give them a little bit extra in terms of pay. Not only that, but also when it comes down to things such as minimum wage increases, things of that sort, it's actually labeled as an increased production cost or increased wages. And this makes complete sense because if you think about it, salaries are one of the biggest expenses that a company actually has to dish money out for. So it only makes sense. If you're going to be increasing your workers' costs by 2% or 3%, or you're going to incentivize new workers by paying them 4% over average, it makes sense that it's going to end up being passed on to us. I know it doesn't seem very fair, but trust me, when it comes down to billion-dollar, million-dollar companies compared to a few cents on our side, we gotta compromise, right? And last but not least, our most favorite topic of them all, increased government spending. Increased government spending also kind of ties in with the government just printing out more money, which they do on a yearly basis, believe it or not. But because of the times where we had with COVID, especially when it came to CERB or the stimulus checks in the States, the government had to print out a lot more money than usual. And this ended up not only messing us up, it ended up messing companies up, which then ended up messing us up even further. I know it's kind of like a little. And not only that, right? I want you to also consider the fact that business grants and business loans were actually given out to different businesses as well. You know those small local businesses that you were supporting? Well, guess what? They were also taking money from the government as well. And let's be real, the government doesn't really have money on its own, so it had to print out money in order to give it to these small businesses or small companies. So for y'all who took those, and for y'all who took CERB, I don't want to hear any complaining from your side. But all of these three things that we just talked about ends up going to the exact same end result, which is a decrease in the cash that you hold. Now, here are three personal tips that I would personally recommend for people to curb inflation or to kind of get around it so that it doesn't affect you in a bad way. The first thing that you could do is actually with your emergency fund or even your fast cash fund. If you have no idea what these are or you don't even have one set up, again, check out one of these corners to actually get the full inside scoop of how to build this thing up. If you haven't, it's one of the most essential steps of the entire financial process. So what are you waiting for? Right click, open in a new tab, and watch it right after this. But nonetheless, you should have your emergency fund within a high interest savings account so that you can pull out the money no matter what the time or day is. Now, usually these guys do give a pretty low percentage rate, but if you can lock 2% every single year, it still is something. But in times of high inflation, such as this year with 4.4%, what can you do? Well, here's the thing. Now you're going to have to take the difference between the inflation and whatever the interest was that you were getting on your high interest savings account. Calculate what the difference was for the end of the year and add that right onto your emergency fund so that it doesn't really lose buying power. Let's look at an example because that might have been a little confusing. So let's just say that my emergency fund was $1,000 for simplicity's sake, and inflation was 4% for the entire year. And I had 2% on the entire emergency fund coming through. Beautiful. So what is 2% of $1,000? 2% of $1,000 is $20. That means that you earned $20 of interest within your high interest savings account for your emergency fund. Beautiful. That already takes care of half the journey. Now, because we know that inflation was 4% for the year, what's 4% of 1,000? That's right, $40. So now that we know that your value of the cash has decreased by $40, but you made $20 from the high interest savings account, that leaves you off with $20 that you just have to put into your emergency fund. That's it. Once you put that $20 into it, that's it. You've basically curved your entire emergency fund from inflation. That's all you have to do. In situations, on the other hand, where inflation is actually less than the high interest savings account you made, you can thankfully say that you've made a profit, even if it's 0.1%, 0.3%. Dude, it's a high interest savings account. Like, you're not gonna get rich off this thing. It's just a nice way to kind of put your cash when it's an emergency, pull it out, that type of thing. Now, how about your investment portfolio or just stocks overall? What are you going to do to actually curb inflation over here? My personal suggestion is always keep a large chunk of your entire portfolio within a conservative investment. Conservative investment, Tamer, what the hell does this mean? Conservative investments is just something that consistently pays you anywhere from 2 to 4% on a yearly basis. And these can be things such as dividend companies, REITs, MLPs. These guys will usually pay you around 4 to 6%, or if it's a regular company, averages around 2 to 3%. Now, when you have these dividends coming on in, depending on the amount that you have dedicated within your portfolio, you've already curbed the effects of inflation. You have nothing to worry about anymore, aside from the actual, stock price going up or down. Nonetheless, if you have a long-term perspective, you shouldn't even have to worry about this in the first place. As for the other portion of your investment portfolio that you're either, swing trading, day trading, options, dabbling around and stuff, that's at your own risk, my dude. Like, Do what you gotta do, whether you're up, you're down. You shouldn't even worry about inflation with that portion of your portfolio, right? And last but not least, when it comes down to cash inflows or business operations, if you have a little side hustle where it's like e-commerce or like products and services overall, regardless of the situation, you want to make sure that you look at what the inflation rate is of the year and then increase your sales price by whatever that inflation was. Now, this is ultimately going to depend on the margins that you already have within the business, along with the industry that you're in as well. But personally, I just like to increase whatever the cost of my product or service was by that inflation amount, just to kind of make sure that the cash still has the same buying power. If you guys want me to touch up on margins and all that type of stuff, let me know in the comments down below and I'm more than happy to break that down for you. But nonetheless, Z Community Cuties, thank you for tuning in. Be sure to like, subscribe, and comment on this video. Let me know what you guys think and let me know what your suggestions are. But for now, it's your boy Tamer Aziz signing out. Peace.